This is going to be a little bit of a unique talk. So I was asked to discuss finances as a physician, as a resident, as a med student, kind of to break down the strategy behind it, to really give kind of like a bird's eye view of what to expect, what kind of roadblocks come up, as well as the things that can really set you up for success down the road long term. At the end of the day, the decisions that you guys make right now as an early med student, whether you're an M1, M2, M3, those decisions have ripple effects through the rest of your life. And I always like to start with the example of should you or should you not buy a house as a resident? Because it's one of those things that nobody gives you a clear answer on. And it's like literally can be the difference of multiple six figures in your overall earnings and your lifetime potential of savings. So I'm going to kind of give you the numbers of when it does, when it doesn't make sense for you to buy a house. It'll be the first thing that we discuss, just because I think it's the most interesting, like big tangible thing that we can talk about. I'm not going to discuss loans on this talk because it's one of those things that everybody kind of has a unique situation, and I'm by no means a loans expert. We are going to talk about financial strategization, talk about the big needle movers, the things that can make a big difference. And to be honest with you, by the time that you guys have to start repaying your loans, there might be some new rule that you don't even have to pay your loans back or something. So who knows? There's so much kind of changes in that sphere over the last few years. So without further ado, I'm going to dive into this. If you guys have questions, definitely drop them in the chat. And then when we're done, I'll just clear through every single person's questions. Everything that I share with you guys is not financial advice. I'm not certified for anything in terms of finances, but I did relatively well for myself as a resident and feel like I somehow actually made the right decisions on a lot of this stuff after kind of networking and asking some people that were years ahead of me at the time. Because oftentimes the general dogma and the kind of quote unquote white coat investor theories that you guys are going to hear over the years, they're actually not really legit, to be kind of blunt with you. And something that I'm going to share with you guys that can be applied to many people, but not everybody, for example, is some of the advice about being super conservative. I think being conservative is really great when you're starting it out. But now when you're young, it's a time where you can't afford to take risks. You have such a long time horizon that if you actually dedicate yourself and apply yourself, you can make a few small changes that can put you really far ahead down the road. So I'm going to share my screen here and let's dive right into it. There's 4 major loan types that you need to know about as M4 or a resident physician that's looking to buy a house. I'm going to basically just tell you what works and what doesn't work. I'm not going to give you like a ton of boring details and stuff like that. Like this is literally, I created this document initially for myself whenever I was in your guys' shoes. And I was like, I want to get a house. Should I get a house? Like that was literally what I wanted to do because I wanted to rent out my rooms via Airbnb and I wanted to make money on the side as a resident. Because let's be honest, your $3,000 or $4,000 a month as a resident doesn't do squat. You know, like after taxes, you're going to be left with like $3,000 or $3,500. I mean, it's not a lot, especially in cities where the cost of living is super high. And you definitely don't want your finances to be something that deters you from picking one residency spot or another. It should be very, very, very low on your priority list. And so this is something that can help you with that to at least just make you more comfortable, you know, like even if it's just a few extra $100 or an extra $1,000 a month, it really, really adds up over time. So the most important thing that I want you to get out of this section of our talk is about using physician loans. This is a phenomenal option that I learned about whenever I was researching buying a house. Is it's a specific loan only for physicians and it applies to you as a resident. And so that's really the awesome thing is you can take advantage of this before you become an attending and before you have a million other things that you got to balance with your life. You can use this loan right now early, especially if 2 things. I recommend this most for people that are in slightly longer residencies. So anything that's like 4 to 5+ years, it's going to be more ideal for your time frame. And the reason being is just because the super short residencies, if you're only there for 3 years, it can be tough to make this a net positive because you have closing costs, you have realtor costs, you have unexpected costs, stuff like that pops up. And so it's hard to actually come out super far ahead if you're only at a spot for 3 years. There's no data behind this, but I did run some numbers back whenever I was in your guys' shoes, and I determined that for my 5-year residency for vascular surgery, it was perfect. I knew I'd come out ahead, but for some of the shorter residencies, it's definitely more difficult. The physician loan is great because it actually allows you to have some flexibility. you do have to use the house as your primary residence. So anybody that's thinking, oh, let me buy like an apartment building and use it as a physician loan, take those advantages, that doesn't work. You have to actually use the house as your primary residence for at least a year. And the key word for all the physician loan stuff is you have to intend to do so. You don't actually have to do it, but that has to be your like legit goal. So going into it, you have to basically say, hey, I'm going to live here for a year. There are other loans such as the FHA loan and the conventional loan. And it's not to say don't consider those, because I always tell my students to keep your options available. You want to check everything out, but just know in the back of your mind that you're probably going to go the physician loan route. But the FHA loan can actually sometimes be the smallest down payment for the different types of loans. And so usually for those, you're going to have to put down 3.5% of the cost of the house. So let's say your house is $100,000, you would have to put down about $3,500. And so conventional loans, they're going to usually require about 20% down payment, which is really difficult for a lot of medical students that are going into residency to put $20,000 down for a house. Or let's say your house is $200,000, you'd have to put down $40,000. That's obviously not very reasonable for a lot of medical students. The problem with FHA loans is they oftentimes will have worse interest rates. So again, that's kind of why the physician loan again comes out ahead. And so in terms of determining which type of loan will allow you to have the greatest amount of cash flow, basically that's going to be a very, very specific situation based upon your credit and the options that your banks allow you to have. So if you determine, hey, I'm going to be in neurosurgery and I'm going to be in residency for 7 years, like you should 100% consider buying a house. And so the first thing you would need to do is to talk to a financing agent at the bank and be able to start talking numbers about kind of where your credit's at, what kind of cash you have available, what kind of term you're looking for. And this is so that you can start kind of spitballing what the monthly payments are going to be. And we're going to get into exactly what my monthly payments were as a resident as well in just a second. So something that I didn't know prior to this whole search is that if you don't put down at least 20 to 25% down payment with the conventional loans, you're going to have to pay something called PMI, which is literally just like a BS way that the banks charge an extra fee onto you for not having a large down payment. So your monthly payment actually goes up. And so it's basically mortgage insurance for the bank to be sure that they're going to get more money out of you. That's what it comes down to. And so if you put less than 20 to 25% of money down for all the loans, except for the physician loan, then you're forced to pay PMI. And so that's a huge benefit of the physician loans themselves, is you don't have to pay that extra fee. And so, for example, even though the FHA loan requires you to only put down 3.5% down payment, you are still going to have to pay for PMI. Whereas again, physician loan does not. All right. And so if you're looking at different interest rates, when I wrote this, 3.5% rate or lower was ideal. That's completely not realistic for right now. If anybody here has recently been looking at getting a house, or if they've been even considering that or hearing maybe their family talking about it, interest rates are like in the 6 to 7% range right now, which makes me feel like ridiculously old, even though I'm like literally just in my early 30s. But whenever I was looking for houses, 3.5 was kind of like the cutoff. Any higher than that, and you felt like you were getting robbed. And the goal was to find a percentage that was less than 3%, like 2.8, 2.9, something like that. So right now, I would say with everything that's kind of going on in the political landscape, you want to try to aim for a less than 6 to 6.5%, but just know it's going to get you one way or another. Essentially, you're either going to pay more for your rent if you get an apartment, or you're going to pay more for the interest on your loan. It's just how it is right now. It's tough out there in the financial landscape. And so I wouldn't just recommend anybody to just dive headfirst into this without even considering renting, because you want to at least see what the rents are going for. Because if it's like $700 a month to rent a reasonable place close to the hospital, but it's $2,000 a month to buy your house and pay the mortgage, obviously you don't want to do that. But for wherever I lived in residency, I graduated from UAMS, it was actually cheaper for me to pay my monthly payment of mortgage than it was for me to rent by a substantial amount, which is crazy. It's not always like that in every single area. Some cities are more built for buyers, other cities are more built for renters in terms of the landscape of prices. But it can actually be cheaper to pay a mortgage than it is to rent, which is crazy. It's like mind-boggling to me. Like, how could it be cheaper? But it really is in some instances. And so here's kind of some decent numbers to keep in the back of your mind. So for residents, banks are usually going to allow a 41% debt to income ratio. It's usually like 41, 42, 43, somewhere around there with conventional loans. And so, for example, if your salary is $50K, the maximum mortgage payment, according to your debt to income, is going to be something like $1,800 a month. You don't want to have to pay that much. If you can find a reasonable house for less, trust me, having the extra wiggle room is super, super clutch. And so the highest that I've seen anybody successfully have loan payment for as a resident without it stressing them was around the 300,000 range. And especially if you're in a more rural area, if you're not in like a super bumpin' city, 300,000 is an insane house, like a legit insane house. So in Arkansas, where I was at for residency, $100,000 is like the same tier of house that my attendings were living in, because it's just so cheap to live there. My house was around the $150,000 range, and I thought it was like way too nice for me as a resident. Like it was really, really nice. Obviously, big cities, that's not going to be the case, right? Like you're going to not have that situation in New York. Like a $150,000 house in New York is like you have like maybe 3 tiles missing out of your ceiling, and you get rained on in the middle of the night. So house prices are definitely going to be different in every city that you're in. But basically, I think a safe area based upon a resident's salary is somewhere around the 150 to 200 range for your overall price of your house. And remember, this is not meant to be a dream house. It's essentially an opportunity for you to make money, to be able to create passive income, and to be able to invest in yourself. Right? This is something that you don't want to have to be doing Airbnb for the rest of your life. Like you don't want somebody to live in your house and basically you house hack for in your 30s and 40s when you have a family. But if right now, if you're young and you want to stack some cash, certainly it's a great option. And so if you want to do more research on this style of investing, it's called house hacking. Better Pockets podcast is really, really solid to discuss this. It's a real estate investing podcast. And so basically what I did was I got a house that was 3 bedrooms. I took the master bedroom and it was kind of isolated off on the rest of the house. And then I had 2 other bedrooms on the far side and we were separated by a hallway. I essentially never even went to the other side of my house, which was just not necessary because I'm one guy and I had a little cat. You know what I mean? Like I didn't need the whole house anyways. And so those other 2 bedrooms, I rented out for each $1,000 a month. That's $2,000 per month of cash flow. And my mortgage was literally like under $700. So if you think about the numbers to that, like I was putting money into the house, which built equity, right? Every month I'm like stacking $700 into the equity of the house. And I'm also free flowing cash flow of about $2,000 a month. So essentially if you think about the breakdown of how much was interest versus the actual principal of the mortgage versus my overall net worth, I mean, I was essentially boosting my net worth by about like $2,300 a month, every single month for 5 years of residency. That's like almost a 1.5x on my salary, which is crazy when you think about it that way. You know what I'm saying? And so there's 2 ways to do this. Let me add somebody to the chat here. Somebody just hopped on. Let's see. There is a few things that you can do that make a big difference in trajectory. But if you think about it like that, like let's just say conservatively, maybe like a $2,300 impact, multiply that by 12 months a year, multiply that by 5 years of residency. That's like $1,000 swing in your net worth. That's not even considering that the house is going to increase in value over that time at an average of 3 to 5% per year. And so my house that I bought for $154,000, I think it was, by the time I sold it, it was worth like 2.25. And so that $138,000 of free cash flow plus the net gain, which after taxes and fees and realtor transaction percentages and whatnot, that was like an extra like maybe $68,000 in cash that I got when I sold my house after 5 years. That's like almost a $200,000 change in your net worth for doing nothing, for just living. And I don't know about you, but having an extra 200 racks is super dope. So did Airbnb primarily, and then I also did Rotating Room. It's another website where you can essentially just post pictures of your house on there, and med students, nurses, different healthcare professionals, rotating doctors, people that are like traveling doctors, they can go on there and rent out your room. I had some people that literally rented with me like multiple months per year, every year, all 5 years I was there, because they're like travel doctors that worked in the ER at the VA down the road. So like I knew these people like well enough that I wouldn't even like have to worry about like locking my house. You know what I mean? Like it was very, very easy because I'm like, dude, this guy's an ER doctor. Like he's not going to rob me. You know, like we were very cool. Like he would like make me dinner and stuff sometimes. It was very, very nice. But it's just to give you an idea that those options are out there. You're not going to fill up your room every single month, always 100% when you first start out. If you don't have your postings very nice, if you don't have good pictures, those kind of things, nobody's going to want to rent out your room on Airbnb. But it's definitely a very, very solid option. And I think there was maybe like out of all 60 months that I was in residency, maybe less than 5 where I didn't have somebody in one of my rooms. Even if one room was filled, was a huge advantage, because think about it, that's $1,000 of cash right there. My mortgage wasn't even $1,000, so I was living for free every single month of residency. So definitely something to consider, that nobody really breaks it down the numbers for you like this. And I think that if you can take anything out of this part of today's talk, is to just know that it is possible, that there are like really big, substantial needle movers that you can make, because 200,000 as a resident is an astronomical amount of extra cash. Like that gives you so much more breathing room to be able to travel to see family. Like I went on vacation with my fiance out of the country, like 3 weeks a year, every single year of residency. Like we went to Europe, to Turkey, to South America. Like we went everywhere, you know what I mean? And I say that to say that you don't have to feel like you're super strapped 24/7, feeling terrible, like super stressed about finances, by just making this one smart move. And obviously you have to do some research to make sure that it's reasonable for your situation. Even if this option doesn't fit your goals and your criteria for an investment, there are other things you can do to invest, and we'll get into some of that as we go. But I just wanted to start off with this because it's like probably the easiest needle mover that you can make in terms of a decision that most people are really, really terrified of. And I know for me, it felt very overwhelming as an M4 to start like making these calls to realtors and start talking with the banks and this kind of stuff. But essentially after I did my elective rotations, I like went full force into figuring this out as an M4. You know, like that whole time frame from like February, when you're just waiting for March for match, and then everything after that, that's just like free time that you can like work on actual goals and like setting yourself up for success down the road. That's like you're hitting the gym like twice a day, you're able to like chill, you're able to read, you're able to get through all that huge stack of personal development books you've been putting off, like whatever it is, you know. So let's dive a little bit more into some of these numbers, and then we'll move on to the next topic. So if you're using a conventional loan, like I said, remember that's the one that requires a 20 to 25% down payment. Basically, you do the down payment times 4, and that's the max purchase amount that you can get based upon your available cash. So if you can put down 40,000, the max amount that you can finance would be 160K. So your loan would be 120,000, which is the difference. These are ballpark numbers, not meant to be like perfect or anything, but this is enough to kind of figure out yes or no, a conventional loan is doable for me. If that's not possible, then obviously you want to look into the FHA loan, and you want to look into the physician loan, which we've been talking about. There's going to be way less restrictions with the physician loan because they understand, like they know that you are somebody that just went through all these years of school, but you're going to be a reliable payer on your mortgage. It's not like somebody that is trying to get a $200,000 house that works at Arby's. You know what I mean? Like that person might not be able to pay it back. Whereas you as a doctor, you are going to be able to pay that back and then some, no problem. And then they want to do business with you, so you get future bigger loans with them down the road. And so let's dive into kind of a few other small details to keep in mind. Most people forget about this. Property taxes are going to be about 1% of your purchase price. So leave about an extra $100 per month for insurance payment for a $160,000 purchase. And then let's talk about cash out refinancing. This is a little bit more of an advanced topic, but just to kind of put it on your guys' radar, the money that you put into your house, you can actually cash out refinance and get that money back for other investments, whether you want to buy another house or whether you want to invest in other alternative commodities or different markets. That's going to be beyond the scope of what we talk about tonight, but just know that the amount of money that you put into your house is not money that's just gone into the ether. Like that is equity that you have developed into your house that you can now draw from. And that's actually how you can get some really, really incredible loan rates that you can utilize for flipping into other properties or to grow your net worth even faster. These are things that are like super advanced techniques that I didn't even know existed whenever I was back in your guys' shoes. And it's like, this is what having mentorship and coaching is about, because you can literally change your entire trajectory of your life and your future family's life by doing some of these things. We talked about the do you intend to stay in the house clause for the physician loans already. This is very important. I want to actually take a moment to talk about this. You almost definitely do not want a variable or adjustable rate mortgage. You want to get a fixed rate. And the reason being is because variable rates oftentimes will look better in the short term, but they can absolutely annihilate you down the road when their rates skyrocket. So let's say that the conventional loan is like a 30-year, 6% fixed mortgage, whereas the adjustable rate mortgage is, they call it like a 5-ARM, for example, 5 adjustable rate mortgage. And so maybe they'll give you like a 5.7% interest, and it looks a little better. It's 0.3% better than the conventional loan. But after 5 years, if you haven't sold that house, that mortgage interest rate can skyrocket to whatever the market is at that time. So it might go from 5.7. Let's say we have a ton of inflation. It could be 9% after that. And so you can get absolutely annihilated trying to save a few percent early on, especially if you have difficulty selling the house. To be honest with you, I thought selling the house was the easiest part of the whole thing. I literally had people make offers on it the very first day that I listed it, but that's not going to be the same for everywhere you go. And I also wasn't trying to like nickel and dime an extra 5,000 or 10,000 here and there on the rest of the properties near me. I was like, let me just give a competitive value. The house is super well kept up. I treated it very nice. I fixed things that needed to be fixed as I was there. I had a maid for all 5 years of residency. She took care of everything. And so the house was very desirable for the area. And so I just undercut everybody by like 5,000 and my house sold immediately. And so the only benefit to the ARM, the adjustable rate mortgage, is if you're confident that you can sell the house as soon as residency is done before the mortgage rates skyrocket after the 5-year term or however many years that the ARM is set up for. I went with a fixed rate mortgage. I was very glad that I did because I didn't have that stress. I knew that the rate that I had gotten, I could comfortably pay off, even if I didn't sell the house for an extra 6 or 12 months because of the market. Maybe there's a housing crash or whatever happened. I knew that I would be comfortable paying that mortgage payment down, and I was totally fine with that. So I definitely, unless you're very advanced with this type of thing, I would probably not even consider the adjustable rate mortgage, even though it looks more appealing on the front end. It's kind of like one of those things that is really good for somebody, and that somebody's probably not you. You know, like there's no free lunch with this type of thing, essentially. And so closing on houses, this is why you have to start like at the time frame that I talked about as a 4th year. You can't do this like 20 days before you move to residency because it takes a while for all the paperwork, all the approvals, everybody has signed their name, all that kind of stuff. Allocate 3 months at least. You know, like you don't want to be super stressing like 15 days till residency starts. You have nowhere to live because you haven't found a house. You haven't signed anything. So definitely start early. That way that you can just be comfortable. Hey, I got a spot. I'm ready. I'm going to make them an offer. I'll tell them when I can move in. Done. Like you want it that smooth. So let's talk about actual real world numbers of what happened to me and kind of what my experience was. So for example, a $225 purchase price, if you have a physician loan, is going to be about a $50 per month payment. So that's kind of ballpark what you should be expecting for a $225,000. My house was $154,000. And I kid you not, when it was like the best house I could have even fathomed for that much in Arkansas. Like I legit had like a grand piano in my house. Like it was nice. So this is obviously depending on your region, it may or may not be doable. But my mortgage payment was $680 a month with my interest rate and the physician loan. And this didn't include like house insurance and some extra fees here and there. Obviously, I also had a maid, which I had to pay and that kind of stuff to make sure that everything was kind of up to par, and took really good care of the house over the 5 years. But that was all very, very easily covered by my Airbnb and rotating room fees that I charged. So before we dive into even more topics, let me go through the chat because I saw that a few people were dropping questions here. Was that helpful for you guys? Sweet. All right, let's see. Peter had a question. With the extra income from renting out rooms, did you decide to pay back the home loan early or invest in other areas? That's actually a phenomenal question. There's no right or wrong answer for that. And so you can do extra payments onto the actual principal of the house, which will cut down the amount of interest that you end up paying over the lifetime of the loan really substantially. So for example, let's say that, just to make easy numbers, let's say that you have an extra $2,000 free per month and you have a $1,000 per month payment. If you put the $1,000 per month payment into your house, probably like 70% of that goes towards interest, and maybe like $300 of the dollars goes towards the actual principal of the house. If you put that additional into the actual payments, called making an early payment, essentially, it will be able to basically shorten the length of time of your loan from 30 years down to like 22, if I had to just take a random guess. Like it'll save you a ton of time on the actual loan, because that goes straight towards the principal and none of it goes towards the interest when you overpay your monthly payment. So that's a very, very solid and super viable option if you're not inclined to research how to invest otherwise. If you're somebody that likes to invest, or you've done research into stocks, Bitcoin, whatever it is, then by all means, invest other places to diversify. But if you just want this to be like your thing and the thing that you put all your effort into, that's a very, very solid option. I personally invested elsewhere. Natalie had a question. Did you ever have to kick anyone out or report anyone to Airbnb? If so, how was it balancing your property and residency? Great question. So I had to do that exactly one time out of 5 years. And it was actually a travel nurse. And so she moved in, and within like an hour of being in my house, she had like destroyed my bed and was like made a mess in the living area, and she said that that's how it was when she moved in. Obviously it wasn't. Like, it's just, I know it wasn't. Like, I have front door cameras and all kinds of stuff, so I knew she was the one that came in. I knew that the time frame and everything, and I had had it cleaned literally the day prior before I left for residency, so obviously I knew it was her. So I did have to kick her out and report her to Airbnb. It's kind of a pain, but to be honest, it was a day or two of wasted effort in the evening, just kind of like typing up my report to Airbnb and whatnot. It wasn't the end of the world. Like, everything's going to have risks. Everything's going to be a small headache. There's no free, easy lunch, like I said earlier. Next question here is, maybe I missed it, but how did you balance property and student loan payments? Thankfully, this isn't something that I personally had to deal with. I had a kind of unique situation in that regard, that I wasn't worrying about student loans. Not to get like super far into my own personal situation, I was just basically worried about paying down the payment. But good question. So I'm not an expert on the different aspects of student loans and whatnot, so I'm not going to dive super far into that tonight. But definitely, if you had to pick between the two, if you're wanting to put that cash towards something, pick whichever one has the higher interest rate. Done. That's the way to do it. And for example, if you have credit card interest, that's your number one to pay off always. The highest interest rate thing is the thing that you always want to put your extra cash towards. And in the vice versa, the inverse, whatever you can gain the most interest on is obviously where you want to put your most money into. And so almost never are you going to be able to consecutively beat the interest rates of money that is loaned to you, because you don't have the capabilities of a big banking entity. And so if you have credit card debt, pay it down, because that's like 20% interest. If you have really high private loans or student loans or anything that's 6 to 10%, obviously you want to pay that down. If your mortgage is low, then you just want to put the minimum to it, right? Like, if your interest rate on your house is 3%, let's say you can find a really good loan, you don't need to like really worry about paying off your house early. Like, your money is better positioned elsewhere, because you're going to be able to beat that 3% in just about any kind of investment.